Hey guys, today we're going to share the 6 steps to do prior to submitting your offer on a multifamily investment property. If you do these 6 steps, you're going to save a lot of time offering on a property, only find out later that you bought a lemon. Faris Capital has analyzed thousands of properties, so we've seen the good, the bad, and the ugly to watch out for, and we're going to share our key insights that we've learned along the way. I'm here with my co-host John here. How you doing, John?
I'm doing good, Mark. As you know, though, my father-in-law had recently passed away, and so we just, finished up the ceremonies. He was a veteran, so we had a beautiful burial at the National Cemetery here in Georgia. But the reason I bring that up is, it really reminded me of something that I think a lot about, and it's the idea that time flies, right? In fact, I actually keep this coin on me at all times. It says "Tempus fugit," which is Latin for "time flies," and on the back it says "All time is quality time." And so, as somebody with kids and watching my wife and her sisters process, their father passing, it was just that good reminder that there is no such thing as quality time. All time is quality time. And, just always look for those opportunities. And, it's something you apply to your whole life, not just with your children, right? But it's that decision on a Tuesday you wake up and maybe you didn't get a good night's sleep and you want to kind of phone it in at the office and just remember, like, you don't know when time will end for you. So make it your best day every single day. And so this little coin in my pocket just helps remind me of that. And, anyway, Jerry Seinfeld even had a thing where he says, you know what I like? I like the trash time, which is when you're cuddled up on the couch with the kids watching a movie and you crack open a pint of Ben and Jerry's too, So it's just that idea. All time can be quality time when you have that mindset, instead of saying, oh, I'm going to carve out this time over here to do something meaningful, right? Just make every moment meaningful. And so it's just really powerful. And it's been helping me process everything that's been happening with my family, but just a really good reminder, right, for me.
Yeah, no, it's a good reminder for all of us as well, John. And
Yeah.
it's interesting that I've heard it all when I was younger. It's like time flies, and now I'm looking at my kids, and my oldest now he's almost 17. I'm
Yeah.
like, what the heck? I'm just holding him like yesterday as a baby in my hands, and now I'm the guy saying, oh, time flies. The kids grow up
Yeah.
fast, and all the rest of this. But you're so right. Like, I think that is so true. It's like all time is quality time. I think the reality is appreciating every minute that you have. I
Yeah.
think is my big takeaway from what you said there.
That's right. And what I love is I love what I do. So it doesn't feel like, it is quality time, spending time looking for great deals, talking with investors and delivering exceptional returns for them and taking great care of our residents. So, that's another key. It's like find something you love to do and it doesn't feel like work. And you're excited to show up every day and give it your all and take advantage of every opportunity that comes your way.
Yeah, right on. So today we're going to be talking about the pre LOI due diligence going in. When I say LOI, it's your letter of intent. So prior to actually making an offer, you make an LOI or letter of intent to the broker that presents to the seller on your behalf. And so this is, I'd say, more predominantly done with the larger multifamily. That is the process. You're not generally submitting an offer. Generally, there's a 1 to 2 week period after an LOI is accepted where, the attorneys are getting involved in, and then you actually sign an agreement of purchase and sale. But prior to that, this LOI happens. And so there's a process before you submit your LOI because, the reality is you haven't actually done deep due diligence yet at this stage in regards to going and doing your financial audits, and you're on site in regards to doing full inspections on the property as well. And so this preliminary LOI process that we're going to share with you gives a chance to still look under the hood and to be very conservative with we'll say your pre-underwriting that you're actually going into this offer with, and you are being conservative with that. And so the hope is that you find out as much as you can in the least amount of time, and that down the road, you're not going back to renegotiate because you missed things. So the steps that we're going to share with you today are going to really help you save a lot of time moving forward when you find that property.
Yeah, and that is so critical, Mark, because that concept of retrading, which is where you go back to the seller and the broker and try to change the sales price after your due diligence, is the number one way to get yourself added on the naughty list amongst the brokers, right? Because who wants to have that conversation? And so at Faris Capital Partners, we conduct a healthy amount of due diligence before we submit that LOI, and that's what we're going to dive into today. Those steps that we take before we even put that pen to paper and submit that letter of intent to that broker. Now, look, if something unexpected emerges, right? Sometimes you have to have that uncomfortable conversation, but the brokers and sellers understand that stuff, right? Some sort of structural issue or a permitting issue that resulted in some challenges with the city that has to be addressed prior to closing. These things happen, but if you do this, if you follow these steps we're about to outline, you minimize that, and you're going in with a strong deal and a strong LOI and putting your best foot forward, which will give you the highest probability of winning that deal. So it's critical you follow these steps as an investor.
For sure. So we're going to start with the first step there, which is getting the offering memorandum. So this is like a glorified feature sheet that the brokers send out, and it's basically it's the feel good of the property, right? It's all professional written in regards to what the property is, what the story is of the property, and it's multi pages as well. So that's the first thing that we ask for is a offering memorandum that basically will spell out, where's the upside in the property and all the details that the broker can think of why we should purchase it.
Yeah, and a well done OM will include everything from, area amenities, satellite photography, so you can get a sense from distance to maybe say grocery stores, schools, parks. It'll talk about economic improvements happening in the area. But one thing you have to remember is this is a sales piece. So it's not to say there's inaccurate data, but they are painting the best possible picture. So it's an important step, but you have to go in with that mindset of going, okay, they're trying to sell this deal here. So do your independent research behind it to verify these facts and to verify these assumptions before you make an LOI and send it out to that broker there. Along with that, we want the T12, which is what we call the financials, right? So it's the trailing 12-year financials. And then you might even play with that a little bit and look at the trends over, say, a T3, the most recent 3 months, or a T6, because maybe in the analysis of the T12 you see a spike in concessions. Maybe in order to get residents in, they started giving away some free rent. And so is that a one-time anomaly, or is that a trend in this property, which could signal challenges achieving your rent? So that T12, those tax bills, when possible, even the insurance loss runs, which is a report that shows insurance claims made on the property. And then, we get into the submarket details, et cetera. But all that has to come through in that step one. So we have the appropriate data so we can do a full underwriting of this property.
For sure. So we have the offering memorandum. We've asked for the T12, which is the trailing 12 months. Basically it's the profit and loss statement. Okay. And then we're going to ask for the rent roll. We're going to ask, and we're actually going to do our own research on the submarket new inventory that's coming on. That's a big one we're going to dive into. Then we're going to figure out on our end, what is the budget for the upside, we'll call it the business plan for the property. So how much money are we going to need to spend before when we go into the property? So we need that in order to do our own due diligence on our side. But this is something that we're asking ahead of time, where's the opportunity for the upside? So if they're like, there's 10 or 100 classic units, then we know based on square footage, because we have an in-house general contractor, how much money we're going to spend in general. We can say conservatively on we'll call it a unit in order to get it up to our standard. So that's
right.
number 5. And then we have the additional DD, due diligence, that we're going to dive into that we do prior to actually going to the property. So
Yeah.
offering memorandum, T12, rent roll, submarket, new inventory, data research, and then the budget for the business plan, and then the additional DD items that we're going to be talking about.
That's right. So let's dive into the financials a little bit deeper. So, what you're really looking for is low hanging fruit. So for us, things like excessive PM fees, large amounts of concessions in a market that has low vacancy. So it could just be a lazy property manager not really wanting to do the work to sign the lease, so they give a free, month's rent. Concessions that we just touched on. You're also going to look at the growth potential rent growth over that 12 months. So are they trending upwards? Are they actually effectively managing this property now What you could actually look for is where they're not doing that, but the market data suggests they could have been doing that, which then points to maybe poor operations or something like that, which goes back to that low hanging fruit. What we really want to see is some strong loss to lease, which is that gap between what is the effective rent and what is the market rent. And so our Largo deal, Mark, was such a great example where just walking in the door, we saw upwards of $250 to $300 loss to lease on their average in place rent. So we knew right out of the gate there was a lot of room to move without even renovating. Now, the plan is to renovate, and we're renovating about 4 to 5 units a month. But in renewals, that gives us some great data on what we can tweak the rents on renewals to start driving that up to closer to market rent. Any other income opportunities, right? Some operators are not great at those added value things that can also become additional income. So maybe we see they don't have a valet trash program. A valet trash program is something most residents love. It's where 2 days a week they put their trash in a specific receptacle outside their door, and a company comes and collects that and takes it to the dumpster. So they don't have to worry about that. You can generally charge $25 a month for that, which is just straight to the bottom line. So we look for almost missing other income opportunities as another example of low-hanging fruit. And then we want to get into things like their marketing and advertising budget. Generally speaking, on a deal that's in performance. So I say that because when we take over a deal in the first 6 months, we aggressively rebrand the property. So our unit cost is a little bit higher in those first 6 months as we build out the websites and take down the platinum packages on the various apartment portals to make sure our property is at the top of the search versus the bottom. So we pay a little bit more for that. But you want to see it settle in at about $150 to $250 a unit. Now that depends on the vintage and some other factors. So that 150 to 250 range. So for example, we're looking at a T12 and they're spending $500 a month. We know we can more effectively market that property at a lower cost and still get the results we're looking for. So those are some of the things. But what are some of the like standard range costs in addition to that advertising and marketing I just mentioned, Mark, that investors should be kind of keeping top of mind?
Just to go back to the PM, so that's property management fees. And so, John, we had a really good example of this. We had a building that we purchased, and he was paying his daughter. It was like over $200,000 that actually showed up, and that was under the property management fee. And so that was some low hanging fruit that we got to, identify and realize, listen, like we can bring that cost way down, which just instantly helped the property perform better. So when you look at the T12, you're looking for these opportunities. We'll call it upside potential when you're going through. So to answer your question, John, insurance is a big one now, and especially in some of the markets that we're investing in, like Florida. The reality is that it's going to be higher. Insurance is going to be higher, but from a standardization, we're looking at about $700 per unit when it comes down to some of the interior markets. So when I say interior markets, like 2 hours off the coast, and so for coastal cities, we'll call it like say Jacksonville and maybe Tampa. You're going to get up a little bit higher, and so you could get upwards into 1,800 a month, or we'll call it per unit per year is what insurance would be. So it could range anywhere from say 1,100 up to it could be over $2,000 based on that. So it's really important that you do your due diligence. You have a strong insurance broker before you submit your LOI. Because that could change the deal altogether.
Insurance has been a deal killer in Florida, right? Because of those unexpected things. And so what could sometimes happen is maybe an operator owns 10 buildings and has some sort of group plan where they're driving their costs down across their entire portfolio. And so say you're looking at a deal in Florida and it is showing $1,200 a unit. You might think wonderful, but the reality is you go get a quote and it might be $1,800. So to your point, Mark, we actually have a great relationship with Real Protect, and they gave us very strong estimates on what these costs would be that we could take to the bank. Typically a little conservative where we come in a little bit lower with our final policy. But it is a huge factor, and you just can't take the financials you get from the seller at face value. You have to go out and do that little bit of due diligence to get those quotes to to ensure that you have the right number, because otherwise you might buy something and then now all of a sudden you have a loser on your hands, because those insurance costs can meaningfully, change the outcome of that investment.
Yeah, for sure. So just to recap on that, interior markets, you're looking at about 700 to, we'll call it $1,100 per unit, and then for coastal markets, you could get from 1,300 even up to 2,000 per unit. And in some cases, John, we saw when the hurricane hit, there were there were a lot of companies there that were they were really increasing their rents, and so they've actually come down a little bit right now. And so those are the general ranges that you're looking at. But the key is to get a really good insurance broker to be able to help you. The next one is the property management fee. So we're looking at about 3 to 4% for property management. And then for us, for payroll, we're anywhere from like 1,200 to 2,000 a unit. In addition to the property management percentage there that I went over.
And that payroll is for the property manager who's on site, who effectively runs that building for us. So they're in charge of the financials, the overall health. They make sure the leasing manager, maintenance techs are doing what they need to do. So that when we talk about that payroll, it's the property manager, it's the leasing manager, and it's the maintenance team. And so depending on the deal size, you might have to have two leasing managers and maybe two maintenance techs, or a maintenance tech and a maintenance supervisor. So that range is usually a pretty good back of the envelope way to kind of estimate what your expenses would be. But if you're buying a 300 unit deal, that's something you need to be mindful of. Your per unit cost may go up, but of course it's spread over more units. So with that, more units being spread, it'll actually pull that number down a little bit. So it's just something to be careful and kind of pay close attention to based on the size of the actual deal.
Yeah, for sure. The next big one actually is taxes. And so we look at the tax bill and we know that in general taxes will be going up. And so we want to know if they're going up and how much they're going up, right? And so in general what we do prior to submitting the LOI is we'll actually call our tax consultant and we'll get verification of what their prediction is in regards to what the taxes will be when we close on the property.
Yeah, so we work with a great company called Ryan Tax Services, and what we love is they give you the good, better and best, so you kind of can use that range. We always kind of go with the worst case scenario, but part of their services post closing is they go in and they try to dispute that tax valuation on your behalf, and they share a little bit in the savings, but having that figure is critical. And states like Florida and Texas and Tennessee with no state income tax, huge advantage, but the reality is they have to make up for that income somewhere else. So you generally see larger property tax bills in those markets, right? Amongst other, taxes that you might experience, sales tax being another example. So really understanding that markets vary and, the tax rates vary. You also sometimes have city taxes on top of the county and so it's something to pay a lot of attention to. And for us, we spend $1,000 for that tax assessment, but it's well worth it knowing that we're putting our best foot forward with the best numbers before we submit that LOI.
For sure. Next one is repairs and maintenance. So this could range immensely from, it could be $250 per unit to over that would be more for a newer build, newer vintage, up to like $1,800 a unit. And so there's a huge range there. You could imagine if you have your HVACs are all new, the maintenance is going to be a whole lot less than if they're all old and you're sending a maintenance tech out there every month to put bandages on them, right?
Yeah, yeah. So looking at even just their turn costs. So knowing for us, for example, we're a value add company. So if we see larger, per unit turn costs, which is that, what we call when somebody moves out and we have to ready that unit for the next person coming in. So we're not talking about renovating in this context. That might just be the new carpet, new paint, and small repairs to tighten it up for that next resident. But if we know we're going to be renovating, then that's a number we can adjust a little bit, because as we renovate those units, newer, higher quality materials being put in, less wear and tear. Hence, we could reduce that turn cost, but it's something to pay close attention to in that underwriting process.
Yeah, for sure. Next one is utility fluctuation. So we're looking for opportunities to save on expenses. So there might be, we'll say, water leaks happening somewhere. Maybe if we saw a spike in regards to the water bill, that's going to be a flag for us. We're going to be able to look into that. But in an ideal world, we want the residents to be able to pay for their own bills. And so John, why don't you talk a little bit about the rubs and what that actually is, and why our preference is that instead of us having kind of a flat rate that we're actually paying on their behalf, they're paying for what they're actually using.
Absolutely. So some operators will just charge a flat rate. Oddly, we've seen where sometimes they're not even really billing back. But a RUBS program, so RUB stands for Ratio Utility Billing System. So basically, we look at the total spend of the utilities that the property is absorbing. Now, the reality is we have some common area space and things like that. Often municipalities will even have rules. So we can't turn utilities into a profit center, to be clear. So we look for a ratio of 85%. So 85% of those total bills are then charged back to the residents on a proportionate share based on their unit size. So, the water bill, the gas, electric, depending on what utilities serve that particular asset, we look at the total bills. And as a company, our number is 85%. We do have to, once again, watch the municipalities, but 85% is generally approvable across most municipalities. So, say, for example, we see they're running a RUBS program at 75%. We know we have an opportunity to increase that a little bit and capture a little bit more of that expense in income back into the property. So it's super important that you dial into that, and then also just look for large increases. So, for example, if you see water spike over 3 months, maybe there was a water leak, and so now that's a question to ask the broker. Tell me more. What was the repair? How did it get fixed? And how are we ensure that there's no future issues? So it's a little bit more than just looking at the numbers. It's also looking for any sort of trends that may emerge, or kind of over 12 months, right? You'll see spikes depending on the time of year. More electricity consumption is a great example in Florida with super hot weather and everybody running their ACs round the clock. So that recapturing of that income is really critical, and making sure that the current owner is effectively recapturing that could create another opportunity for you as an investor.
For sure. And so part of the T12 that we actually asked for is a work order history there to be able to see like where are all the maintenance, where's the time actually going. And so part of that is actually reaching out to your insurance broker and actually seeing like from a lost run standpoint, were there any claims that were made? And so that will tell us a really good story in regards to our numbers, and be able to help us better predict moving forward if those costs are going to be the same and what our actual insurance numbers are going to be working out to.
And through that, right? So say for example, you get the work order history in from the property, and you see that there's constant issues with HVAC systems, and they're going out and they're slapping a Band-Aid on it. That means we may have to budget for a certain amount of system replacements, because what we also have to consider, at least as we look at deals, is opportunity costs. If our maintenance techs are constantly dealing with that issue, by replacing those units, if the deal can support it, that reduces the workload on those items, which will allow them to provide even better service on the smaller things. So, for example, sometimes we see where there's a lot of issues with the simple stuff like sinks are clogging or toilets and things like that. So that's where we might consider looking at the plumbing system as part of our due diligence. We always do that. We do a full cammering of the lines, and we just make sure everything's in great working order. But it gives you a good sense of what to expect when you take over ownership, and also ways that in your renovation program you can maybe address some of these things to reduce some of that future cost on those maintenance items.
Right on. So, John, let's get into the third part of this, which is rent roll, and this is where it gets exciting for me. So George, our asset manager, will go through the T12 with a fine tooth comb, and so the rent roll is something when we have that sent to us, I'm like a kid in a candy shop because, John, this is where it tells us how low of rent they're currently charging, and so what is the potential upside that we can actually increase rents to be able to, we'll just say, have some strong lift and get higher returns for our investors. But so the rent, what is the rent roll, and what does it actually show us so that the listeners have a better understanding?
Yeah, it's a critical document. So it's essentially a full accounting of every lease. So it shows, the unit square footage, the unit type, one bedroom, one bath versus two bedroom, two bath. It shows, their original lease rate at the time they signed the lease, the date they signed their lease, date their lease expires, and on. So one of the things we have to look at is if we have a large amount of lease renewals coming right after we take ownership, we have to be really mindful of that. And that could actually be something that causes us to pause a little bit. Or maybe we might see people are on month to month leases, which we don't like. So just it helps us understand what we're going to have to deal with when we take this asset over. We would also look to see, are there any affordability components, right? So things like Section 8 rentals and things of that nature, which we're not necessarily fully opposed to, but we generally try to shy away from because it just creates more work and more red tape. We also want to look for things like student or military concentration. Understanding with students, they typically are in for 8 or 9 months and then they're out. And so student housing is a whole other animal when it comes to multifamily. And most operators that take on student deals, that's kind of what they do because it is almost like a different level of expertise required, and you have to manage all your leasing activity happening in 1 month and all your move outs happening in 1 month, right? So it's just a different kind of a deal. But we would look at that. We look at that military concentration primarily because by law, if there's a deployment, we have to release these folks of their lease. So that just gives you a sense of potential future exposure should something like that happen. And a great example right now is Donald Trump is talking about deploying some military to the southern border. So there might be some military movements. So towns with high military concentration could feel a little pain there. So we love military. We want to support the military, but we don't necessarily want to buy a building that's 90% military because it's just a risk exposure for our investors. But that average lease term, as I mentioned, is really important. And then, just looking forward, right? What do we have to think about in terms of future lease expirations and things like that? But the key thing we're looking for is that loss to lease. So our Charleston portfolio was a great example where their average in-place rents were about 1350, but we knew the market could support 1650 plus on these classic units. So there's a lot we're looking for there. Those are some of the key items we immediately drill down into.
Yeah, for sure. So we're analyzing the rent roll, and then the next is the submarket new inventory data. So this is something that we spend tens of thousands of dollars to get access to CoStar. And so CoStar is one of the platforms that we look at to be able to identify what is actually coming to the market. So not only like what's coming to the market today, but like what's coming to the market a year down the road in regards to new deliveries or new apartments or new competition, right? And so we want to know what's coming down the pipe. And so you can really find a deal that looks phenomenal, right? But if you have like 300 units that's coming right across the street, you should know that's coming down the pipe. And the cool thing is we can identify that ahead of time. And that's part of our pre LOI due diligence. And so that's something there that the story that we're seeing now and the markets that we're buying is that those deliveries are being absorbed into the market. And so they've been getting absorbed. And so now moving forward, in a lot of the markets coming into 2025, there's no new deliveries coming on the market. And so not any for the foreseeable future, which is very telling, which is very encouraging. And then there's other markets where 2025, there's still going to be some new deliveries hitting, but coming into 2026, I haven't seen the markets that we're in right now and we're looking at, John. Like I haven't seen a market where 2026 is going to have a whole slew of inventory hit the market because when interest rates doubled, a lot of the developers, most of like all of them that I know, they basically put their projects on hold and they weren't building.
Yeah, new groundbreaking on multifamily deals was down over 50% from 2024 to 2023. And those higher interest rates, those higher materials costs, some uncertainty in the marketplace is causing those developers to pull back. But that submarket report gets into a lot of data. It goes historical and some forward-looking projections. So things like occupancy, vacancy, organic rent growth. So it shows the history and then what they're projecting into the future, taking into account new inventory coming in. It actually has cap rate history, cap rate projections. So we really look at that and then go a step deeper into the demographics. So what are the average income and the median incomes in the area? What's the makeup of the population there? What's the unemployment rate? What's the future population growth in a 1 mile, 3 mile, and 10 mile radius around the property? And all those data points I mentioned are actually presented in that way: 1 mile, 3 mile, 10 miles. So you want to see strong population growth, low unemployment trends, new jobs coming into the market. So those submarket reports break all that down for you. So a really great deal could be sitting in a submarket that has challenges, right? Maybe low to reverse population growth. People are moving out of the area. So all those have to be taken into account. And one of the metrics, Mark, we talked about on previous podcasts is that rent to income ratio. That's certainly something we're dialing into. And it's actually like one of the third things Mark and I ask our, on the investor committee meetings, is like, what's that rent to income ratio? Because we know if it's over 35%, it's going to be hard for people to afford. And we don't want to be in a market where there's pressure on affordability.
Yeah, for sure. And that brings us to the next point, the budget for the business plan. And so this is where we whip out our 20 plus page underwriting model that we built out through the years here, John. And so this is where a lot of deals, the preliminary is actually done, but then when we run it through our model in regards to our future projections and we look at the business plan, so how much do we need to do renovations to be able to get those higher rents? And so this is where a lot of deals get squashed through this underwriting, but we need to know what is the business plan to be able to drive higher returns. And so this is something that we're looking at. Okay, if there's 100 units in this building and say all of them are classic units, well, we know for us that our average unit turn to be able to go in and renovate, we're talking stone countertops, we're talking vinyl plank flooring, nice, light fixtures, paint. These units are anywhere from like $13,000 to $15,000 a unit. And so we know we can do a really great job with that. And then we also know based on the size, because we've done this many times where we'll go in and say, listen, we can spend 50,000 in landscaping or 100,000 in landscaping in order to get it to our par. But we do reach out to our GC, our general contractor, at this point to be able to verify these costs, to be able to plug it into our underwriting model to say yes or no.
That's right. And on top of that, we added 10% contingency just to account for unexpected fluctuations in materials costs. And so that number may change in the future as we watch the cost of materials with proposed tariffs and things like that. But to your point, this is really the business plan at the end of the day. So how are we going to renovate these units to what quality? And for us, we want to have that standard Faris touch, right? The granite countertops, all those things you just mentioned. And so sometimes the deals just don't support it and the market just doesn't support it. And so that might be a deal we pull back on. That's also where we look at those other income opportunities we've talked about in the past, that valet trash, tech packages, and things like that. So this underwriting model takes all that data and kind of spits out the returns, and then we can kind of look at that and make sure, because for us, it's very important that we underwrite very conservatively. Our goal is to always overperform. And so it's where we spend a lot of time in this due diligence process, making sure we're meeting the market with the kind of unit they're looking for in a way that's cost effective, that will drive those returns.
For sure. So I'm going to do the next section here in like super rapid fire form. So this is the extra due diligence that we do. So first thing, crime stats. So we go on spotcrime.com and it tells us, is there a lot of crime in the area? Now, we're not talking about kind of the more of the petty, but if there's any shootings, we're just not going there. So that's the first thing. And then we go to Google. And with that, we'll actually type in the property address. And that'll tell us a lot about the history of the property. We love Google. We're looking at the reviews as well. This is where, John, I know you and I, we get really excited. If we see a low Google review score, that is great opportunity for us to go in and just do a better job looking after the residents. Flood zones, this is another one that we look at. So we look at the FEMA online site to be able to say, is this in a flood zone or not? If it is, we're not going there. We're reaching out to the chamber, okay? And we're looking at the local economic department there to be able to say, yes, what kind of jobs and businesses are actually coming into the area. We're going back to Google Maps and we're actually looking at the surrounding area before we actually fly out there and go and see it. Is we want to know what the surrounding retail is. Okay, what kind of proximity, and is it close to major shopping and roads, and amenities and jobs, right? And then we're looking at population growth. We're looking at the overall demographics there as well. And so you can find out a lot online prior to actually doing your deep due diligence and prior to submitting your LOI.
Yeah. No, and there's many websites that we utilize. So just for simplicity, what I would say is on our newsletter. So if you go to fariscapitalpartners.com, you can sign up for that newsletter. In the coming weeks, we'll actually send out a free report with those key websites that we use. Or if you just want to email me at john@fariscapitalpartners.com, and you can just put in the subject websites and I'll know what it is. And I'll be happy to share those websites that we utilize on a daily basis along to help you in your due diligence process or in your review of a potential investment. Happy to share that along.
Yeah, for sure. And so this is like so important because when we submit an LOI, at that point, like we believe that we're going to actually close on that deal. And so in many cases, we're putting hundreds of thousands of dollars in hard money down from day one when that agreement of purchase and sale is signed. And so, and we had one case, we had $600,000 down, and we knew we needed to do some extreme due diligence prior to actually doing our deep, we'll call it on-site property due diligence in regards to the inspections and the property condition assessments and the reports there from all of the third parties, but then also the financials and the leasing audits that we do as well. So you can do a lot prior to going in. And if you're conservative with it, then you can go back after and peel it back. And John, that's probably one of the biggest things that we do really well is that I've seen is we're not coming back after and saying, "Oh, I forgot about that." It's like, no, we're the numbers that we're doing are pre-due diligence on. It's conservative where we're going back after and say, "Hey, the deal's actually it got a lot better."
That's right. Yeah, and when we go to our brokers, we make sure they're aware of all this due diligence we've done. We actually provide a cover letter that gets into the details on all these steps we've taken so that the broker knows this isn't just a flyer or it's just not some random LOI just to see maybe they'll bite kind of thing, that we're serious about buying this property. We're backing it up with hard earnest money. And here's all the research we've done. Here's our quotes. Here's everything we have. And that just positions us strongly with those brokers. So when they go to their sellers, they say, look, these guys are easy to work with and they've done all their work. They've done the research and they've committed to not retrading outside of some major unforeseen circumstance. And that well positions our offers. And candidly, Mark, we've won deals as a newer company with this strategy, right? So it's a strategy that works really well and ensures that our investors are well looked after.
Well, I mean, you think about it, the broker's doing their due diligence. They're going to ask you, what do you factor in for your insurance costs? And if
Yeah.
you don't know that cold, like what do you factor in with your taxes? Like what you factor in there? And if you don't know that's not going to give them a lot of confidence to go to their seller and say, yeah, these guys are going to close on the deal. But if
Yeah.
it's like, listen, here's our insurance broker. We already have solid quotes there. We've already gone to our tax consultant. We've already done, all of our due diligence on all these items. That positions you much stronger than another group that's just winging it,
Yeah.
right?
That's
Yeah.
right. It's all about positioning. And, brokers want to know two things. Can you close and are you easy to work with? And
Yeah.
so this approach demonstrates both of those things.
For sure. So just some closing key takeaways there as you're doing your preliminary LOI due diligence. Number one, ask for the offering memorandum. Number two, the T12, so the financials over the last 12 months. Number three is the rent roll to show what the current rents are. And then we're getting into the submarket new inventory reports, the budget for the business plan, and then the additional DD that we shared with you. If you start with those and you go through those six, it's really going to give you a competitive advantage on your next offer and save you a lot of time.
That's right. It's actually fun, right? It's actually
Yeah.
one of the things we love to do. Looking at deals, and one just came on the market today, and thankfully it was 15 minutes away. I dropped everything, got in the
Yeah.
car, and drove over, and we started this process. So we geek out on this kind
Yeah.
of stuff, right, Mark?
No, that was great. I love seeing that video. You texted me a video of the property. I'm like, holy geez, John, you got there quick. But it was like right around and that's one of the benefits of you actually being in Atlanta. That's one of our markets that we're looking to acquire in. And so, being boots on the ground and just being like, close by as well is another advantage moving forward. But, bottom line now, you can jump on a flight and, you could be there in an hour or two.
Yeah.
But it sure is nice when it's right in your backyard.
Yeah, love it. Yeah,
Yeah.
it's a fun way to spend a morning, that's for sure.
Very cool. All right, guys. Well, thanks for listening in. The mission of the show is to be the ultimate guide for high net worth multifamily investors. If you enjoyed it, please subscribe and share with other investors that you think will benefit from it. We love and believe in you guys. Keep dreaming and investing big.